The United States and China have been entangled in a complex economic dance for decades. This intricate relationship, however, is built on a foundation of immense trade. Over the past 10 years, from 2015 to 2024, the value of trade between these two economic giants has consistently surpassed $600 billion annually. In 2024 alone, China exported approximately $450 billion worth of goods to the U.S. This substantial figure represents a significant portion, about 18% of China's total exports. Conversely, the U.S. exported around $150 billion to China in 2024. While this number pales in comparison to China's exports, it still constitutes a considerable 7% of total U.S. exports. The sheer volume of these figures underscores the deep economic interdependence that has come to define the U.S.-China relationship. For years, businesses and consumers on both sides have grown accustomed to the benefits of this intertwined trade relationship. However, the potential for a complete severance of these ties poses a significant threat, one with far-reaching consequences for both nations and the global economy at large. The ramifications of such a scenario would be profound and multifaceted, impacting industries, consumers, and global supply chains. Understanding the specific sectors and potential losses is crucial in grasping the magnitude of a decoupling between the world's two largest economies. The immediate and most apparent consequence of a complete halt in U.S.-China trade would be the economic fallout. Both nations would experience significant disruptions to their respective economies. China, heavily reliant on its export-oriented growth model, would face a sudden and substantial loss of market share in the U.S. This loss would translate into decreased revenue, factory closures, and potential job losses across various sectors. The Chinese economy, already grappling with slowing growth, could be pushed towards a recession. The U.S., on the other hand, would find itself grappling with a different set of challenges. The readily available and affordable goods from China would vanish from store shelves. This scarcity would lead to higher prices for consumers, forcing them to bear the brunt of the trade war. Furthermore, U.S. companies that rely on Chinese manufacturing would face soaring production costs and logistical nightmares. The impact would reverberate throughout the U.S. economy, potentially triggering inflation and slowing economic growth. Few sectors highlight the interconnectedness of the U.S. and Chinese economies as starkly as the technology sector. American tech giants like Apple, Google, and Tesla have become heavily reliant on Chinese manufacturing for their products. A severing of trade ties would leave these companies scrambling to find alternative manufacturing hubs. Relocating production is neither swift nor cheap. It involves building new factories, training workforces, and navigating unfamiliar regulatory landscapes. Such a massive undertaking would take years and cost billions of dollars. In the interim, production delays and supply chain disruptions would become the norm. The consequences for consumers would be immediate and palpable. Prices for smartphones, laptops, and even electric vehicles would skyrocket as supply dwindles and demand remains high. The technological edge that the U.S. has long enjoyed could be blunted, as innovation is stifled by logistical constraints and rising costs. Section 4. Fashion's shifting fabric. The apparel industry, a significant beneficiary of globalization, would also find itself in turmoil. Major clothing brands including Nike and Gap have long relied on China's vast manufacturing capabilities to produce their garments at low costs. The sudden loss of Chinese factories would force these companies to embark on a frantic search for alternative production locations. However, replicating the scale and efficiency of China's garment industry is no easy feat. Countries like Vietnam, Bangladesh, and even Mexico, while potential contenders, lack the infrastructure and skilled labor force to immediately fill the void. This would lead to production delays, shortages, and ultimately higher prices for consumers. The fashion industry's reliance on China's manufacturing prowess has been a double-edged sword. While it has allowed for lower prices and a wider variety of choices, it has also meant that a significant portion of global garment production is concentrated in a single country. A decoupling of the U.S. and Chinese economies would expose the vulnerabilities of this model and force a reckoning within the fashion industry. Section 5. A world realigned. The consequences of a U.S.-China trade war would extend far beyond the borders of these two nations. The global economy, already grappling with uncertainty and volatility, would face further destabilization. Supply chains that crisscross the globe would be thrown into disarray, leading to shortages and price hikes for a wide range of goods. Developing countries that rely on exports to either the US or China would face economic hardship. The rules-based trading order, already under strain, would be severely tested. In the ensuing chaos, countries would be forced to choose sides, potentially leading to the formation of new economic blocs and further fragmentation of the global economy. The ramifications of a US-China trade war are too vast and interconnected to predict with absolute certainty. However, one thing is clear: the world as we know it would be irrevocably altered. The economic interdependence that has come to define the post-Cold War era would be replaced by a new era of uncertainty, competition, and potentially conflict. As the world grapples with the overarching consequences of a US-China trade war, it's crucial to examine the ongoing tariff battle between two key figures, President Donald Trump and President Xi Jinping. This trade dispute has not only strained the economies of both nations but has also sent ripples through the global market. Under Trump's administration, tariffs were imposed on billions of dollars worth of Chinese goods, aiming to reduce the US trade deficit and bring manufacturing jobs back to American shores. In response, Xi's government retaliated with their own tariffs on American products, ranging from soybeans to automobiles. This tit-for-tat escalation has led to increased costs for businesses and consumers in both countries. The impact on the US economy includes higher prices for imported goods, putting a strain on American consumers and businesses that rely on Chinese components. Meanwhile, Chinese manufacturers have faced declining export orders, leading to slower economic growth and increased unemployment. This tariff tussle has not just been about economics, it has also been a battle for technological superiority and geopolitical influence. Both Trump and Xi have used the trade war as a platform to assert their respective nations' dominance on the global stage. In the broader context of our video, this ongoing tariff fight exemplifies the complexities and far-reaching effects of a US-China trade war. It underscores how intertwined and interdependent our global economies have become, and how actions taken by two leaders can reverberate across the world, reshaping the economic landscape and altering the course of international relations. As we move forward, the world will continue to watch closely, hoping for resolutions that bring stability, yet preparing for a future marked by uncertainty and competition.